If you're watching this, chances are you're someone who understands that investing in real estate is a fantastic way to secure your financial future. From residential properties that form the heart of our communities to commercial buildings that drive our economies and even raw land ripe for development. Each type of real estate investment presents unique opportunities and benefits. But navigating these waters can be complex and, at times, challenging. But don't worry, we've got your back. In this video, we will uncover the 7 strategies of real estate investing that have been proven to secure financial futures. These are strategies used by successful real estate investors across the globe, and we're sharing them with you today. Imagine being part of this group of successful investors, having your money work for you, creating passive income streams, and building a solid financial foundation for yourself and your family. One of the biggest advantages of investing in real estate is the potential for steady cash flow. When you own a rental property, you can collect monthly rent payments from your tenants that can provide a consistent source of income. This is especially useful for retirees or those looking to supplement their existing income. In addition to cash flow, real estate also offers excellent long-term appreciation potential. Over time, your property can increase in value as demand for housing and commercial space grows. This means that if you decide to sell your investment property down the road, you could potentially earn a significant profit on your initial investment. Another benefit of investing in real estate is the ability to take advantage of tax benefits such as deductions for mortgage interest and property taxes. Before investing in real estate, it is essential to have a clear understanding of your goals. Determine what you want to achieve through real estate investing. Are you looking for rental income, long-term appreciation, or a combination of both? Understanding your goals will allow you to choose the type of investment property that aligns with your objectives. It is also crucial to determine your investment timeline. Are you looking for a short-term or long-term investment? This decision will play a significant role in the type of investment strategy you select. When setting goals, it's essential to be realistic and evaluate them regularly as circumstances may change over time. Real estate investing involves risks such as market fluctuations, unexpected expenses, tenant turnover, and others. As an investor, it's critical to understand your risk tolerance level when selecting investment properties. If you are risk-averse but want exposure to real estate investments, consider lower-risk options such as REITs or crowdfunding platforms. On the other hand, if you have a higher tolerance for risk and are comfortable with more significant financial commitments and management responsibilities, options such as rental properties or fix and flip investments may be more suitable for you. Risk tolerance also plays a role in determining how much leverage, debt, an investor should take on when acquiring a property. For example, investors with low risk tolerance would opt for less leverage while those with high risk tolerance may take on more debt to maximize their returns. Understanding your goals and risk tolerance levels are crucial factors that can help guide your real estate investment decisions. By having clear objectives and evaluating the risks involved realistically, investors can make informed decisions that align with their personal circumstances and financial goals. Real estate investing involves a range of strategies, each with its own benefits and drawbacks. Understanding the different options can help you determine which approach is best for your investment goals and risk tolerance. Here are 3 popular strategies to consider. 1. Fix and flip. This strategy involves purchasing a property, making renovations or repairs to increase its value, then selling it for a profit. The goal is to buy low and sell high quickly. This can be a high-risk strategy as it requires accurate estimates of renovation costs, market value of the home after repairs, and an understanding of the local real estate market. 2. Buy and hold. With this strategy, investors purchase a property with the intention of holding onto it long-term and earning passive income through rental payments. The goal is to build equity in the property while generating cash flow from rent payments. This can be a more stable investment strategy but requires careful consideration of ongoing maintenance costs and rental income potential. 3. Rental properties. Similar to buy and hold, this strategy involves purchasing properties specifically for generating rental income over time rather than selling quickly for profit. It may take time to build up enough properties to generate significant passive income, but rental properties can offer consistent cash flow that will increase over time. Each investment strategy has its own set of pros and cons that should be considered before making any decisions. Fix and flip. Pros include potentially quick profits if renovations are done correctly. Cons include higher risks due to unexpected costs or market shifts. Buy and hold. Pros include steady cash flow from renting out the property. Cons include ongoing maintenance expenses that may cut into profits. Rental properties. Pros include consistent long-term income. Cons include high upfront costs and potential headaches with tenants. It's important to research each strategy in depth and consider your personal investment goals before choosing the right approach for you. As with any industry, networking is an important part of real estate investing. Building relationships with other investors, real estate agents, and professionals can open doors to potential investment opportunities that you may not have found on your own. These relationships can also provide valuable knowledge and insights about the local market and industry trends. One way to build a strong network is by attending local real estate investment group meetings or events. You may also consider joining online forums or social media groups dedicated to real estate investing, where you can participate in discussions and ask for advice. When building your network, it's important to approach it strategically. Here are some tips for building a strong network. 1. Be genuine. The key to building any relationship is being genuine and authentic. 2. Offer value. Networking is a two-way street. 3. Attend industry events. Attending industry events such as conferences or trade shows can be an excellent way to meet new people and learn about new trends in the market. 4. Follow up. After meeting someone new, be sure to follow up with them within 24 to 48 hours via email or phone call. This will help solidify your connection and keep the relationship moving forward. By following these tips, you'll be well on your way toward building a strong network of contacts that will help take your real estate investing career to the next level. Before investing in real estate, it is important to secure financing. One option is traditional mortgages, which are offered by banks and other lending institutions. These loans typically require a down payment of 20% or more and have fixed interest rates for the duration of the loan term. Traditional mortgages are appealing for long-term investments such as rental properties. Another option is hard money loans, which are short-term loans that use the property as collateral. Hard money lenders typically do not consider a borrower's credit score, but they do charge higher interest rates and fees than traditional lenders. Hard money loans can be useful for investors who need quick access to cash or need to finance a property that does not qualify for traditional financing. Private lenders are another financing option that provides flexibility in terms of loan structure and repayment terms. To secure financing for your first investment property, it is important to have a solid financial plan in place. This includes having a clear understanding of your credit history and score, as well as your debt-to-income ratio. Having good credit history helps you secure favorable terms from lenders since it shows you have been responsible for previous debts you incurred. It also enhances your chances of securing more beneficial interest rates or better repayment plans. Another key element when securing financing is ensuring that your income can cover the monthly payments even during periods when there may be no tenants or market fluctuations happen. To increase your chances of being approved by lenders, work on improving these areas before applying for funding assistance so you can get better rates than if you weren't diligent on achieving good benchmark scores beforehand. Being prepared for all possible scenarios, including market downturns and unexpected property issues, can help investors secure financing for their first investment property. By understanding the different financing options available and having a solid financial plan in place, investors can set themselves up for success in their real estate investments. When it comes to real estate investing, one of the most important steps is identifying potential investment properties. It's crucial to conduct research and evaluate multiple properties before making a decision. The process of researching potential investment properties involves a combination of market research and property evaluation. Here are some tips on how to conduct effective research on potential investment properties. The first step in researching potential investment properties is conducting market research. This involves identifying areas with high growth potential, analyzing current market trends, and studying the overall economic climate in the area. One way to do this is by working with a local real estate agent who has extensive knowledge of the area and can provide valuable insights. Another way to conduct market research is by using online tools such as Zillow or Redfin to look at housing prices and trends in various neighborhoods. It's also important to consider factors such as job growth, population growth, crime rates, schools, and amenities when researching areas for potential investments. Once you have identified an area with high growth potential, it's time to start evaluating individual properties within that area. There are several factors you should consider when evaluating potential investment properties. Location. The location of a property can greatly impact its value and rental income potential. Look for properties that are located in desirable neighborhoods with good schools, transportation access, and other amenities. Condition. It's important to evaluate the condition of a property before making an investment. Consider factors such as age of the property, maintenance needs, and any necessary repairs or upgrades. Market demand. Evaluate the demand for rental properties in the area by looking at vacancy rates, rental prices, and the number of similar properties on the market. By conducting thorough research and evaluating potential investment properties based on these factors, you can make informed decisions and increase your chances of success in real estate investing. When you're just starting out in real estate investing, it can be tempting to jump in headfirst and go after the biggest, most impressive properties you can find. However, this is often a mistake. Starting small and working your way up over time is a much safer and more sustainable approach to investing. There are several reasons why starting small is so important. For one thing, smaller properties are generally less expensive than larger ones, which means they're easier to finance and have lower upfront costs. Additionally, smaller properties are often easier to manage, especially if you're just getting started in the world of real estate investing. By starting with something manageable, you'll be able to learn the ropes without being overwhelmed by too many moving parts. Once you've successfully invested in a few smaller properties, it's time to start thinking about scaling up. Scaling up involves gradually increasing the size and complexity of your investment portfolio over time. There are many different ways to scale up your real estate investments. One common strategy is to reinvest profits from your initial investments into bigger and more lucrative properties. Another approach is to partner with other investors or take on investors of your own in order to pool resources and tackle larger projects together. Of course, scaling up comes with its own set of challenges. As properties get bigger and more complex, they become harder to manage and require more specialized knowledge. That's why it's important not to rush into anything too quickly. Take the time you need to build experience and develop your skills organically. Real estate investing can be an incredibly rewarding venture for those who are willing to put in the work required for success. By focusing on clear goals, educating yourself on different strategies, building your network, securing financing, researching potential investment properties, and starting small and scaling up over time, you'll be well on your way to building a profitable real estate portfolio. Remember that success in real estate investing is not a sprint, it's a marathon. Be patient with yourself and your investments, and don't be afraid to seek out guidance and advice from more experienced investors along the way. With hard work and dedication, you can achieve great things in the world of real estate investing. Thank you so much for watching. If you enjoyed this video, please give it a big thumbs up by hitting that like button below, and make sure to hit the subscribe button and turn on those notifications so you never miss any of our future uploads. We have a lot of amazing content lined up, and we can't wait to share it with you.